What if I told you that while everyone's chasing the big names in the automotive revolution, there are penny stocks flying under the radar that could potentially transform your portfolio? Hello everyone, I'm William, and welcome back to the channel where we break down complex investment opportunities into actionable insights. If you're new here, I analyze emerging stocks and market trends to help you make informed investment decisions. Today, we're diving deep into the automobile industry's transformation and uncovering two companies that are positioned at the very heart of this revolution. But before we get to these hidden gems, you need to understand why the next few years in the automotive sector could create wealth like we've never seen before. The automotive industry is experiencing a seismic shift. We're not just talking about electric vehicles anymore, we're talking about a complete reimagining of transportation, energy storage, and sustainable technology. The global EV market is projected to grow from roughly 14 million units in 2023 to over 40 million units by 2030. That's nearly a 200% increase in just 7 years. But here's what most investors miss. It's not just about the cars themselves, it's about the entire ecosystem supporting them. The battery technology, the charging infrastructure, the autonomous driving systems, and the manufacturing innovations that make it all possible. This is where smart money is positioning itself right now, not in the obvious place, but in the companies building the foundation of this new automotive era. When we look at penny stocks in this sector, we need to be strategic. These aren't your typical speculative plays. We're looking for companies with real technology, legitimate partnerships with major automakers, and a clear path to profitability or at least to becoming acquisition targets for larger players. The risk is higher, absolutely. But so is the potential reward. The key is doing your homework, understanding the technology, analyzing the financials, and most importantly, recognizing which companies have the relationships and the intellectual property that could make them invaluable in the coming years. Now, our first company is absolutely fascinating because they're not trying to build cars, they're trying to solve the single biggest bottleneck in the entire EV industry. Battery technology. This company is working on next-generation solid-state battery technology. And if you know anything about the EV space, you know that solid-state batteries are considered the holy grail. Current lithium-ion batteries have limitations in energy density, charging speed, safety concerns, and degradation over time. Solid-state batteries promise to solve all of these issues. They can potentially double the range of electric vehicles, reduce charging times to minutes instead of hours, eliminate the fire risks associated with liquid electrolytes, and last significantly longer. The company I'm talking about is Solid Power Incorporated, trading under the ticker SLDP. Solid Power is a Colorado-based company that's developing all-solid-state battery cells for electric vehicles. Let me give you the financial picture because this is crucial. As of their most recent quarter, Solid Power reported revenues of approximately $2.8 million from their pilot production facility and engineering services. Now, I know that's not a lot of revenue, and you're right to notice that. But here's the critical context. This is a development stage company. Their current business model involves developing the technology, proving it works, and licensing it to major manufacturers. Their cash position is strong with approximately $455 million in cash and equivalents as of the latest quarter, and minimal debt. This gives them a runway of several years to continue development without needing to raise additional capital. Their technology is what makes them potentially valuable. Solid Power is developing sulfide-based solid-state batteries using solid electrolytes instead of liquid ones. This isn't just an incremental improvement, it's a fundamental redesign. Their technology promises energy densities of over 930 watt-hours per liter, compared to around 700 for current best-in-class lithium-ion batteries. They're currently producing prototype cells on their pilot line, a 45,000 square foot facility in Colorado capable of producing hundreds of cells per week. They've successfully manufactured cells in automotive-relevant form factors, including their EV cells, which are about the size of a standard laptop battery. But here's where it gets really exciting. The partnerships. Solid Power has collaboration agreements with BMW and Ford Motor Company. Two of the biggest automotive manufacturers in the world are betting on Solid Power's technology. BMW has invested in the company and is actively working with them to develop batteries for future electric vehicles. Ford similarly has a joint development agreement and has also invested capital. These aren't just financial investments, these are strategic partnerships where the automakers are dedicating engineering resources to work alongside Solid Power. Management has indicated they've delivered E-cells to their automotive partners for testing and validation, moving them from the laboratory to real-world automotive applications. In their recent quarter, Solid Power reported a net loss of approximately $23 million, which is in line with expectations for a company at this stage. Their operating expenses are primarily focused on research and development, which totaled around $18 million for the quarter. They're not burning cash on excessive marketing, they're investing in developing and proving their technology. Management expects to achieve certain technical milestones before moving toward commercialization, targeting the latter part of this decade. Now let's move to our second company, and this one represents a completely different play in the automotive transformation. While our first tech is a technology enabler, our second company is an actual vehicle manufacturer. This is a company that's been called the Tesla of China, and it's trading at a fraction of Tesla's valuation. I'm talking about NIO Incorporated, trading under the ticker NIO as an ADR. NIO is one of China's leading premium electric vehicle manufacturers, and they're expanding aggressively into European markets. NIO's financials show they're in a completely different stage of development. In their most recent quarter, they reported revenues of approximately $2.66 billion, representing a year-over-year increase of roughly 7%. They delivered over 61,000 vehicles in that quarter. They're not a concept company, they're a real manufacturer producing and selling vehicles at scale. Their gross margin has been improving steadily and reached 13.1% in the latest quarter, up from 11% the previous quarter. This margin expansion is critical because it shows they're getting more efficient at manufacturing. NIO's vehicle lineup is impressive. They currently offer multiple models including the ET7 sedan, the ET5 and ET5T, the C6 and EC7 crossovers, and the ES6, ES7, and ES8 SUVs. They're covering the entire premium segment, positioned to compete with brands like BMW, Mercedes, and Audi. Their newest brand, ONVO, targets the mass market with more affordable options, with the L60 SUV starting at around $30,000 in China. In early 2025, they're launching their third brand called Firefly, focusing on urban compact vehicles for European and Chinese markets. What really sets NIO apart is their innovative battery swapping technology. Instead of waiting hours to charge, NIO owners can drive into a battery swap station and have their depleted battery replaced with a fully charged one in under 5 minutes. They've built over 2,600 battery swap stations globally, with more than 2,400 in China and expanding into Europe. This infrastructure is a massive competitive advantage representing billions in capital investment that creates switching costs for customers. NIO's partnerships are equally impressive. They formed a battery swap alliance with several Chinese automakers including Chery, Geely, and Jack, meaning their swap stations can serve multiple brands. They've partnered with CATL and are developing their own semi-solid-state batteries expected to launch in 2026. They're heavily invested in autonomous driving with their NAD system, comparable to Tesla's full self-driving. They've partnered with NVIDIA for computing power and are developing their own chips to reduce costs. Looking at their cash position, NIO has approximately $6.5 billion in cash and cash equivalents as of the latest quarter. They've secured multiple credit facilities from Chinese banks, giving them access to additional capital as needed. Their monthly vehicle deliveries have been trending upward, with recent months seeing over 31,000 deliveries, putting them on track to exceed 200,000 deliveries annually. The China market opportunity, staggering. China is the world's largest automotive market and the largest EV market by far. NIO has established itself as the leading domestic premium EV brand. But they're expanding into Norway, Germany, Netherlands, Denmark, and Sweden, with plans for further European expansion. They're building NIO houses, lifestyle centers and showrooms in major European cities. This international expansion diversifies their revenue and positions them as a global brand. Now let's talk about risks. For Solid Power, the main risk is technology execution. Solid-state batteries have been the next big thing for years, but scaling to mass production at competitive costs has proven difficult. Competition is intense with QuantumScape, Samsung, and Toyota, all working on similar technology. For NIO, risks include intense competition in China from BYD, XPeng, Li Auto, and Tesla. There's geopolitical risk given US-China tensions affecting their ADR listing or international expansion. Both companies are not yet profitable on a net income basis, meaning they're dependent on capital markets remaining supportive. However, the potential upside is significant. For Solid Power, if they successfully commercialize their technology and BMW or Ford commits to using it in production vehicles, the stock could multiply several times over. They could become an acquisition target for a major battery manufacturer. For NIO, if they achieve profitability as margins improve and scale increases, and if their European expansion succeeds, the current valuation could prove extremely attractive. They're trading at a fraction of Tesla's price-to-sales ratio despite having comparable technology and a strong brand in the world's largest EV market. Let me quickly walk you through this infographic summarizing everything we've covered today. On the left, we have Solid Power, a development-stage battery technology company with $455 million in cash, strong partnerships with BMW and Ford, and solid-state battery technology promising over 930 watt-hours per liter energy density. Their risk profile is high with technology execution being the main concern, but the reward potential is exceptional if commercialization succeeds. On the right, we have NIO, an established premium EV manufacturer with $2.66 billion in quarterly revenue, over 61,000 vehicles delivered last quarter, and a unique battery swap network of 2,600 stations. Their margins are improving at 13.1% gross margin, and they're expanding into Europe with multiple vehicle brands. Risk factors include intense competition and geopolitical concerns, but profitability is within reach. My recommendation: Solid Power for aggressive investors seeking breakthrough technology exposure, NIO for those wanting established operations with growth potential. Both require careful position sizing and risk management. So here's the bottom line. These are two very different plays on the automotive revolution. Solid Power is a high-risk, high-reward technology bet on the future of batteries. NIO is a more established but still growing bet on electrification with unique infrastructure advantages. Both offer potential substantial returns if things go right, but both carry real risks. This isn't financial advice, and you should never invest more than you can afford to lose, especially in penny stocks. Do your own research, read the filings, understand the technology, and make informed decisions. Let me quickly walk you through this summary. Left side, Solid Power. Development stage battery tech, $455 million cash, BMW and Ford partnerships, high risk but exceptional reward potential. Right side, NIO, established EV maker, $2.66 billion quarterly revenue, unique battery swap network, profitability within reach. Solid Power for aggressive investors, NIO for growth seekers, both require careful risk management. If you found this analysis helpful, hit that subscribe button and turn on notifications so you never miss an opportunity. The automotive revolution is just getting started, and positioning yourself correctly today could make all the difference tomorrow. I'm William, and I'll see you in the next one.